Good afternoon, and welcome to the Spring 2026 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM and head of real estate software at Actis AI. We're pleased to have an insightful program for everyone today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using Zoom, and I'd like to address a couple of housekeeping items before we get started. On the audio front, all of the participant audio is muted, meaning we cannot hear you. And that's by design, and that will remain the case throughout. If you're attending by computer, take a moment to refamiliarize yourself with the control panel elements. We will be showing the slides, but if you'd like to download them, I will be putting them in the chat, a link to them in the chat. You don't need to have the slides up on your end, but if you would like to download them, certainly feel free. While we've included the usual slides for everyone to have for their own use, we're going to do a little bit of a different presentation today. And as always, we're going to reserve 15 to 20 minutes at the end for questions. Feel free to send your questions through at any point in time by putting it in the Q&A field and make sure you click send. And if you get disconnected at any point, just reconnect the way you did originally. If you're registered, later today you will receive an email with a link to the recording and the slides, and the video will also be posted on the Linneman Associates website later today. And without any further ado, I'd like to introduce our presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, how are you and where are you?
I'm in Philadelphia as we approach the 250th anniversary of the nation, which occurred about 4 blocks from my office and 2 blocks from my home. So come to Philadelphia for the 4th of July celebrations and celebrate the nation. One of the things we're going to do in the Linneman letter that comes out, basically July 1st, it'll come out, is we will include the actual Declaration of Independence just as a reminder of it all. So it's a lovely day in Philadelphia. Let's go to the first slide, Bruce. And I'm going to do sort of a quick status report of the economy. I don't have to tell you there's uncertainty geopolitically and in terms of oil prices. In terms of our economy, the geopolitical part less relevant, the oil price more relevant. Interestingly, the US as a whole gains modestly from higher oil prices because we're a large exporter of oil. We're the largest exporter in the world. We've increased our oil exports during the Iranian situation. So there's more money coming in. If you think about, well, gee, I'm paying more for my gasoline and petroleum products and so forth. Yes, you are, but basically someone else in the country is receiving it. So I'm oversimplifying in saying that if you look at the nation as a whole, we gain on the export side. And for everyone who loses for paying higher oil prices in the country, somebody else is receiving them. The problem, not a problem, the reality is that the gains are quite concentrated and the losses within the country are quite broadly spread, namely everybody who buys petroleum. On the other hand, if you're in the Permian, this is a great time. If you're in Houston, it's a good time. If you're an owner of an oil or gas company in the United States, it's a great time. And of course, those of us with ETFs and index funds, they're benefiting to the extent the oil companies are benefiting. So it's a complicated situation where the pain is broadly spread and the gain is quite concentrated, but net net, it is a modest gain for the country. Um, if you look at how the consumer appears to be adjusting through the first 2 months, the consumer is dealing with higher gasoline and oil product prices by saving about 1% less of their income. I'm oversimplifying, which is to say consumption is unchanged. Um, People are basically buying the same amount of stuff. They're paying more for their gasoline, et cetera, and they're just reducing their savings to offset how much more they're paying for gasoline, et cetera. Whether that will last forever, we'll see. Interesting thing is capital markets in the US have functioned straight through this. As you know, the um, stock market took a crazy drop and then has rebounded. Um, you look at the debt markets are functioning quite well. We actually had a couple of loans closed a week after it all began. They went off without a hitch. And I think that's the case across the board. The long-term interest rate in particular is up. And so pricing is up. Spread is narrowed a bit to offset some of that. But net net, there's no doubt the interest rate scenario is up. I'll come back to that. GDP in real terms is growing 1.5% to 2%. Um, Benchmark is we get about 1.6% productivity growth a year. And then we have about 70 basis points of population growth. So a normal benchmark for GDP growth would be add the two together around 2.3%. I'm just giving you a general view. And so when we're doing at 2% or below, we're growing. We're absolutely growing. We're growing per capita. Remember, we're only growing 70 basis points of population. So we're growing per capita, we're growing in total, but below benchmark. There are some indicators that this second quarter will be a very high GDP growth number on an annualized basis, perhaps 4 to 5%. Mixed signals on that. Um, I think that's higher than it'll come out, but we'll see. Federal government has 11.7% fewer employees than in December 2024. It's a remarkable reduction. In the near term, it's probably a slight downward pressure on the economy as those people transition from one job to another. In the longer term, I believe that it will be productive and that they'll move from jobs that are a lot about slowing growth and impeding growth to the private sector, which is about creating growth. Um, and I'll come back to this, the employment growth picture is very murky. The data gets weaker and weaker in its robustness. It is becoming at least as much noise as signal from the payroll data, partly because response rates are down, processing of it is getting complicated. I think we supposedly only added 181,000 jobs last year. My guess is it's closer to 800,000 jobs. That's around the pace we've been on through the first 4 months of this year. Um, the problem is, when's the last time, I'm going to simplify this, when's the last time you answered a phone call from a number you don't know? And the answer is long time ago. Well, that could have been the Bureau of Labor Statistics calling you and asking you to participate in the survey. And when people don't respond and when firms don't respond, imagine yourself as the statistician. Does a non-response mean they just chose not to answer, or that they're out of business and people like them are out of business? And you have to do a very different thing to the data. And the more people don't respond, the more challenging that problem becomes. We do have a great indicator that no firing is occurring. The initial unemployment insurance claims have been very, very low. They came out today, they've stayed very low. Those are pretty reliable numbers. They only lag by a week. So the numbers that came out today were for last week. And remember, basically, people show up to get their money. So they're not coming from surveys. So they're not perfect data, but they're pretty robust data. And it pretty clearly shows nobody's getting fired. One of the things I'm going to predict, and I would remind you, in the last 2 years around this point, I said interest rates were coming by year end. No one believed it. And both cases, they did come because of the fundamentals. I think you're going to get 75 basis points cut to the short-term rate yet this year, um, mainly because inflation other than oil products has gone back down to 2.2, 2.3%. And yes, there is inflation coming from oil prices, but the Fed raising interest rates is not going to open the Strait of Hormuz. And so for them to try to, quote, tamp down inflation by raising the interest rate actually will exacerbate the situation, because petroleum refiners and exploration companies will see their cost of capital go up. And as their cost of capital goes up, their exploration and refining will go down. When you can't control something and you behave as if you can only do meddlesome harm. And I'm very hopeful the Fed does not raise the rate. I hope they hold it through. Then people say, yeah, but there's all this inflation. What goes up with oil comes down with oil. And I would remind you that after the Ukraine situation began, oil went up to $120 a barrel. But if you adjust for inflation, that's close to $135 a barrel in today's dollars. And then you come back a year, 2 years later, oil's back down to 60, $70 a barrel. So yes, it was inflationary on the way up, but it's equally deflationary on the way down. And it will reveal that the fundamental inflation is down around 2.2, 2.3% when you strip out the silly owner equivalent rent, which is the rent that owners pay themselves, but they don't pay themselves. They're not out of pocket for it. The long rate is way too high, but that's because it has to compete with the short rate, and the short rate is too high. That's why I think it gets reduced. And there's a fear that the Fed will further raise the rate to, quote, tamp down inflation. And I think when you'll see the long rate come down as oil prices recede. And as oil prices recede and a deflationary sets in on that price, you'll get a very different picture. The tariff picture is running its course. It was about $3 per $100 in 2024. It was just over $10 per hundred in 2025. That's a pretty notable tax increase on 10% of the economy. That definitely slowed the economy. The Supreme Court rulings and some other factors are going to, I think, make the average tariff come back down from about $10 per hundred to a probably $4 a hundred. And that will be effectively a tax reduction that will spur that sector. Manufacturing still staying flat. That's because rates are too high. I remind people that recoveries last 6 to 8 years, and we're now in the fifth year of this recovery, early in the fifth year. And then when people say, well, will anybody still want to invest in the US? Um, you want to invest in Dubai right now? Do you want to invest in Oman right now? How about Qatar? You want to invest in Qatar? How about China? How about Taiwan? How about, and I can do the how about, um, and we still are the top choice. We may not be spectacular, but we're the top choice. And it's almost like Wayembe, he would probably be the first person you'd pick for your team right now in basketball, even though he should put on 30 pounds of muscle. But yeah, but still, even without the 30 pounds of muscle, he's who you'd pick, right? And that's the United States. Yes, if we could put on 30 more pounds of muscle, we'd even be more dominant. But just remember that when you watch him perform in the game, I think tonight. So, okay, go to the next chart. And I'm going to go through these kind of quickly. You've because I've covered some of those. I use S&P 500 in the short term as an indicator of confidence in the economy, at least by people betting on the profitability and future of the US economy. And it dipped as the Iranian happened, and it's above. And I simply marked in red its previous high before the Iranian situation. And it's above, when I looked this morning, it's above this, which I think we finished Monday. So this is like 2 days out of date, but it's nothing particular. So confidence is still pretty good. Let's go to the next. People say, this is, again, the next chart is the federal deficit. This is, yeah, but wouldn't Wayembe be better if he had 30 pounds more muscle? Might the US economy be in better shape if the federal government didn't spend as much and didn't have these deficits? Yeah, that's very possible. On the other hand, um, we're running about a $2 trillion deficit right now at the federal government level. There's some off balance sheet stuff and so forth, but let's just call it 2 trillion. That's on about a $32 trillion GDP. Um, and that's backed by the full faith and confidence of the US citizenry. So if you go to the next, the outstanding federal debt is the blue line as a percent of GDP. And you can see over the last few years, it's actually drifted down, even though we've been running debt, because the economy is growing somewhat faster than the deficits. The red line is, okay, let's take out all the debt that the US government owes itself. So there's a lot of intra-company debt, primarily debt held by the Social Security Administration and by the Federal Reserve. So if you think about it, when Treasury writes a check for interest payments, a huge amount of that money is received either by the Social Security Administration or the Fed. Or another way to think about it, if the government was to pay off their debt, a lot of that money would go from the federal government right back to the federal government. So the red nets off, and it's a less kind of urgent line, not saying good or bad, but it's a much less dramatic line. And, we have debt outstanding at about 60% of GDP. Another way quick to think about that is imagine a piece of real estate that had debt that was 60% of its operating income. And I don't think many of you on your properties have debt as low as 60% of your operating income. And so, in that light, it's not that high. The orange is the debt. Remember that most of that federal debt is owned by US citizens, banks, index funds, ETFs, individuals. So that, again, yes, the money goes from Treasury, but it mostly goes to US citizens. Only the debt associated with the orange, namely foreign holders, actually leaves the country, so to speak. And you can see that that peaked more than a decade ago. And this notion of what happens if foreigners stop buying our debt, they stopped buying our debt a long time ago. That's not to say they don't buy it, but they're not expanding their holdings relatively. Um, and part of the reason is some of those countries aren't growing very much. The UK, for example, GDP per capita is essentially the same as almost 20 years ago. In Germany, GDP per capita is basically the same as 10 years ago. Um, so the debt is not as high as people think. If you go to the next chart, real quick, I covered this last time. How long can we run deficits? Well, I'm 75 years old, and for all those 75 years, people are saying we can't keep running these deficits, it'll destroy the economy, and yet the economy just keeps going. Not saying the deficits are why it's going, I'm just saying we can do it. And the simple way of thinking about this is Elon Musk is supposedly worth what, 500 billion? How long could Elon Musk spend 5 billion more than his income? And the answer is 100 years if he's worth 500 billion, right? And you say actually more than that because the 500 billion is generating income. So essentially he could do it forever because if he had 500 billion of income and it generated a 1% return, that's 5 billion. So even if his 500 billion only generates 1% return, he could run 5 billion a year just on that 1% return. And of course, you would expect he makes more than 1%. Well, that's the US. We have about 175 trillion in household wealth, roughly. Um, Against that is about $27 trillion of federal debt that, quote, we owe collectively. Now, remember, most of that 27 trillion we owe ourselves, but let's ignore that for a moment. And that says we've got about $148 trillion net wealth. That doesn't count off balance sheet commitments by the government as liabilities, but it also doesn't count things like the value of drilling rights that are held by the US government, or the value of forests, or the value of US office buildings owned by the government, et cetera. So it's a quick and dirty. That 148 trillion net wealth was 540 billion when I was born. That's almost an 8% annual growth. You go back to the Elon Musk example, right? That's almost an 8% per annum growth. Even if it only grew by 5% a year, it would generate 8.7 trillion in additional wealth. And how much is the deficit? Two. If the deficit is 2 or 2.3 to be precise, and we're generating 8.7 trillion more wealth a year, our net wealth is actually up 6.4 trillion. How long could we do that? Forever and ever and ever. Why? Because we're rich and we grow. If you're Zimbabwe and you're poor and you don't grow, you can't do this. I can't run $5 billion debts relative to my income, right? But Elon Musk can. And that is if you're big and you're growing, you can do it. And that's the US. I'm not saying we should, I'm saying we can. And not only that, we're not robbing our grandchildren. In my little example, we're giving them 6.4 trillion more after doing 1 year deficit than if we would have just given them their inheritance to start with, right? So what it really is, we're just giving them a little less. It's almost like I'm going to go out to have dinner with Jeremy Siegel. Some of you know Jeremy. Jeremy and his wife are having dinner with Kathy and me tonight. And gee, we're going to spend money. And our heirs could say, oh, gee, you're robbing us because you're eating out. I think we would say, screw you. We have a right to spend our money the way we want to spend it, right? And so that's why I say we as a society have decided we don't want to cut spending. I may want to cut it, but we as a society have decided we don't. We've decided we don't want to raise taxes. We've decided we don't want to print a lot of money. So what do? We buy debt. How do we have the money to buy debt? We've got a lot more wealth, and we would like some of that wealth to be held in US debt. You can almost imagine what the deficit is doing is saying, gee, you're a lot wealthier and you want more federal debt for your portfolio, and we'll accommodate that by running more debt. And so it can go on. Whether it should is a different question. Go to the next. I'm going to go through these quickly because I've talked about them. Real GDP, the light blue is the trend. The red is where it was when COVID hit. The dark blue is the actual. We're pretty much back to trend. We pretty much have caught up. It's within what? It's within rounding error. Let's just put it that way. So the economy is okay in that regard. If you go to the next, same chart for employment, where was employment in the red before COVID hit? The dark blue is what actually happened. The light blue was the pre-pandemic trend. Employment is below trend. How are we below employment? How are we below trend on employment, but basically on trend for GDP? The answer is productivity growth. You have productivity growth, and so even though I don't have as many people, those I have people, but I don't have trend number of people, but I have the productivity of those people making up the gap. Go to the next. I kind of already talked about this, and you can go through the numbers when you download. This is the 181,000 last year. I puzzled about this. Um, I go through, essentially it said everything other than healthcare lost jobs. I don't believe that. I lived in the economy last year. You lived in the economy last year. It wasn't an economy where the only sector I saw adding jobs was healthcare. I'm not saying it was a great year. When you cross tabulate retail sales and this and unemployment claims and that and that and that and that, um, I guesstimate we added about 800,000. That's probably about half of what would have been trendish. So not a great year last year. The economy slowed, especially in the second half. The data slowed more because non-response rates went up, particularly among small firms. Given what was going on with ICE, I don't care whether you think it's good or bad, that's not the point. Imagine a data responder who gets something from the government as all that's going on, and you've got 32 illegal immigrants working for you, and it says, how many employees do you have? And there's no punishment for not answering, and there's no reward for answering. I just don't answer. And that means the data nerds have to figure out, are they out of business? Which means a drop in jobs, or is it non-response? And the non-response, especially among small firms, picked up by the end of the year. We have added as the ICE stuff is damped down a little bit, the data becomes a little more realistic over the last few months. It would say we've added about 300,000 jobs over the last 4 months. not a spectacular rate. That's an annual rate of 900,000. That is consistent with what we're seeing on GDP. That is consistent with what we're seeing on unemployment claim and retail sales. Go to the next. Initial unemployment insurance claims, low. This is unemployment insurance claims, new unemployment insurance claims, as a percent of the labor force. You see how bizarre 6 years ago was. I mean, it makes every other weak economy seem out of touch. Um, but they are still quite low. Go to the next. The unemployment rate for youth and for in general, still pretty low. The labor force participation rates are back basically for everybody but people in their 60s. So I want to say 60, 60 and above. And people 60 and above still have not recovered their labor force participation rate. Yes, the participation rate among youth is much lower than it was 20 years ago, 10 years ago, 30 years ago, but it's basically back to where it was just prior to the pandemic. So it's really among seniors, and I've not seen anybody have a great explanation of why. Go to the next, single family housing. This is the net surplus if it's above zero, shortfall if it's below zero. The housing bubble in 4 years went from about a balanced market to about 2.2 million more homes than we needed for people at that moment in time. Production then ceased. There were several years where we actually destroyed more single family homes than we built. And we went from a surplus to, by 2012, we had a deficit. Since 2012, which by the way is 14 years, that deficit has grown to about 3.7 million homes. Some analysts estimate as high as 5 million. The lowest number I've seen is around 2 million. Everybody using a little different methodology. Point is, big shortfall of single family homes. And that's the best thing multifamily has going for it, is there's a shortage of single family homes. You add to that, that people had low locked in mortgage rates and they're hesitant to move at the normal schedule, and buying homes has become difficult. If you think about homes built 10 years ago as a used home, think of it as a used car analogy, a used home. People who buy used homes, there aren't enough of them out there. It's not so much that the number of new homes is a shortfall. If you look at the last few years, the shortfall hasn't changed much. So we're producing enough homes roughly to meet the demands of people who want new homes. What we don't have is enough used homes. And that's where the shortfall hits, and it really shows up on median income households, probably 40 to 85 percentile households are the ones that really bear that burden. Go to the next, real adjusted for inflation. Sales is best one can estimate through brick retail. In real terms, they're up. They're not rising. So if they're flat, it says basically it's keeping up with inflation. Or another way of saying it is unit throughput is about the same. And that's consistent with, you look at the retail sector, strong retailers are doing well, strong retail centers are doing well, weak ones are doing poorly. Net net, not a lot of growth there. If you go to the next, you're back to e-retail is where most of the growth is going. However, 6 out of every 7 sold are still being sold through brick, not counting auto. Go to the next, the interest rate picture. I like long pictures. You see the red and which is the 10-year treasury, and the blue, which is the short-term rate. They're both high, and they're high by standards of now the last 16 years. And they're too high. The short rate was too low all through the 2010s. Zero is not what it should have been. I wrote and spoke about that. In the same way, if you turn your shower temperature up to all hot, you'll burn. If you turn it to all cold, it will hurt you. As you go from all hot to cold, you're improving your comfort, but you hit an ideal point and you can go too far. So the goal isn't that lowering the interest rate helps the economy or raising the interest rate hurts the economy. It's relative to a comfortable temperature. And we're above uh, the interest rates where they should be. It's cooling the economy more than it should be. Go to the next real quick on the Fed. You know how much I love the Fed. I think I don't know Warsh. Um, I believe he's a pretty good appointment. We'll see. The institution itself is a troubled institution. It really has been. Inflation for the 30 years prior to the pandemic, net of owner equivalent rent was 2.2%. It has been 2.3% for actually now the last 14 months, if you also take out oil for the last 2 months, which is to say everything other than oil is is kind of sitting right where it was for 30 years prior to the pandemic. The Fed needs to understand they cannot open the Strait of Hormuz with anything they do. And while the temptation to do something is there, just because there's a temptation to do something doesn't mean you should do something. So you have oil right now as the only catalyst of inflation, but the flip of that is as oil comes down, um, you'll get the reverse. If you go to the next chart, it's the consumer price index inflation rate for items people purchase that excludes owner equivalent rent. It has, the red is the long average. It has bounced around. You can see for the last 2 years, it's been right on average, which was not something to worry about. You can see in the last 2 months, it ticked up. And that's the tick up above the line you see. It's not as dramatic as you might think. Um, and I think you're going to see it come back down. Go to the next. Banks still have a lot of capacity to lend. Um, you still have more bank reserves than you did at the peak of QE3, but they are down notably from the peak of COVID. And so I think you will see more lending coming out. I think the Fed will encourage, especially with wars, they're going to encourage banks to lend more and to hold less at the Fed. They hold huge balances at the Fed. Go to the next chart, and it's price of oil. I do West Texas, but by the way, if we did Brent, it would look the same as a chart. So this is West Texas. The light blue lines mark the high and low in real terms. The red is just the arithmetic average over that long period. And you can take away two things from this chart. One is it's volatile, and what goes up generally comes down. Second, today's high isn't that high in real terms. And you go back to 2022 when the Ukraine situation happened, it was higher then than now. Um, and it came down. And you can go back to other episodes and it came down. And what people forget is on the other side of these ups are downs. And the reason it comes down is because the production cost is way below the spot price. And while US oil producers were we produce 21, 22% of all the oil that gets produced in the world. Um, uh, the number two is Saudi Arabia, historically at about 11%. Um, and we know that the producers were making money when oil was at $60 a barrel. They may say they don't want to expand, just like all the apartment developers said, no, I'm not going to develop. And then they all did. You're going to see expansion here, and that will pull things down. Real quick, I'm not going to dwell long on it. Data centers, the numbers are staggering. Time will tell whether it's smart or dumb, but the numbers are staggering. The hyperscalers were in total investing about 35 billion annually in 2025. They're on a run rate of 170 billion this year. If you go back 5 years ago, their investment rate was about 8 billion. So in the near term, staggering excess demand because of all the money that's flowing into AI and all the servers they need and all the capacity they need. Whether that's long term or not, time will tell. You have obsolescence issues, you have technology issues, you have what does quantum do issues. You have, yes, we have more trend up demand, but ever smaller racks and better cooling. All those things, time will tell if it's right. In the near term, extraordinary margins, no proven exit. And so you can see that data center development went from basically $2 billion a year a decade ago to $40 billion today. The supply has gone from 455 last year and is on a pace with what is already pretty much under construction to be around 650 million by the end of next year. The only comment I would make is I don't know how it all turns out, but if you go to the next chart, everybody says, well, yeah, but the demand's going to grow and the demand's going to grow and the demand's going to grow. And I looked up the employment in physicians' offices. This is government data. And by the way, I don't think you can find anything that over a long period of time has grown more regularly than that, with the exception of a very brief when they shut down um, non-essential medical during COVID 6 years ago. You could not find something that's grown more or more steadily. Does that mean every medical office facility has been a home run just because there was steadily growing and lots of demand? No. There are lots of failed medical office facilities out there because they had too high a cost basis. They were built at the wrong location. They were built with the wrong design. They were over levered. Um, they aligned with the wrong medical system in Philadelphia here. If you aligned with Hahnemann, you got crushed. Right now, Temple University's medical is struggling. Even Jefferson University's medical is struggling. All those medical office facilities surrounding them, if they go down, it's not like they're not going to be more doctors. It's just they're not going to be there. And so the real point of this is just because there's a steadily growing demand in aggregate does not ensure project success. And I just encourage people to remember that. Okay, I'm going to do just a couple of real quick charts to wrap up. If you go to the last, and this will be updated in the next Linneman letter, and I'm not going to go through all the numbers. We took NACREIF data and we just did mechanical 10-year holds. We did mechanical 7-year holds, and we did mechanical 3-year holds. That is, you bought in the first quarter of 1980 and you sold it 3 years later, or 5 years later, or 7 years later, or 10 years later. These are unlevered. And so these are kind of the property, if you will. Okay. And what you can see is um, what was the average CAGR, which is the annual return. Okay. And you can see on the 10-year what the annual return was for the different sectors. Industrial and multi have done best. If you look at the standard deviations, that is the volatility, multi and retail tended to have the lowest volatility. If you do the Sharpe ratio, which is the return divided by the standard deviation, you get more return per volatility from multifamily with retail and industrial about the same, and office being the lowest. And then what was the minimum return you got on any 10-year hold? What was the maximum return you got on any 10-year return are the next. These are unlevered. And then how many negatives did you get on a 10-year hold? And none of these properties categories unlevered have a negative 10-year return. Now, stick around. We'll find out as we move forward because this constantly changes. Below it, you'll see the 7-year, and I'm not going to go through them in detail. The average return is pretty much the same. The the um, the rankings are pretty much the same. What really changes is the upside and downside changes on the 7-year hold versus the two. Bigger upside on a seven, bigger downside on a seven. And you start seeing some negative returns, particularly for office. And then go to the third one. If you go to a 3-year hold horizon, even unlevered, the average return doesn't change much. The standard deviations are much higher. The Sharpe ratios are much lower. That is, you're getting a lot less return for the volatility you take on when you go short. But you can really see it dramatically in the lines of the minimum return you got. You start seeing negatives appear for all property types on a 3-year hold. You don't see it at all on a 7 or 10. You get um, higher maximum returns. If you time it right, you do spectacular, much better. And you start getting, though, a fair number of negative returns happening as you go short. So you can chew on that more. And then the other, we did the same thing for NAREIT. I'm not going to show it. It shows pretty similar, except NAREIT's got modest leverage, so the averages are a little higher. You get a little more upside, you get a little more negativity, but it's the same story of bigger ups on short holds, but bigger downs on short holds are accentuated. And then the last one, again, just to chew on, what is the average of these holds, these 10-year holds, pre-COVID, post-COVID? And across the board, everything is down in its return except industrial post-COVID. All the property categories are down post-COVID by a good amount. And industrial is up, but not dramatically up. The standard deviation is up notably on industrial. The others, yeah, a bit. So since the returns are down, obviously the Sharpe ratios are down because you're not getting any return. So there has been, at least for the last 6 years, a different kind of return pattern happening that's worth keeping your eye on. Last chart. One other thing. This is real, that is adjusted for inflation, construction cost indices. One is the Turner Index, which is more for high rises. And the other is the Linneman Index, which we put together, Debbie Moy and I put together, and it is more geared to low rise, mid rise, stick construction, et cetera. Um, the you see the actual in dark blue, dark red. The cost of high rise construction has gone up notably more. That is, Turner's gone up notably more than the Linneman, not because it's better or worse. I think it reflects high rise versus low rise. These do not include regulatory delays or regulatory costs. These are kind of materials, labor, et cetera. The trend lines are in there. So the light green is the trend line of Turner. And what you'll see is in real terms, the Turner is right on trend. It has a positive trend of about 1.5% a year, um, uh, in real terms, with a lot of volatility. And the blue, the Linneman, has also an upward trend, not as dramatic, but it is an upward trend over time. And these, in a way, are your replacement cost benchmarks that ultimately set value for the competition, which is new construction. But the interesting thing is both Turner and the Linneman indexes are back on trend, pretty much. So I'll end there, Bruce. That's a little territory we covered in Linneman letter, but we never covered in the seminar.
Great. Thank you very much, Peter. Informative and insightful as always. We've had quite a few questions come through. Several are asking about the debt markets and why you think banks might be incentivized to deploy more capital and what are the drivers and how is that going to impact cap rates and the markets generally?
Okay, so Warsh has said he wants to shrink the balance sheet of the Fed. The balance sheet of the Fed largely are holdings by banks without going into all the nuances. As he shrinks, if they do shrink it, I don't think they'll shrink it overnight. They have been shrinking it, but as they shrink it, they're going to be paying banks less interest for doing nothing. So one of the things that happened with the financial crisis is they pumped a lot of money into banks. They did it again during COVID, and they paid the banks interest to not lend. If they stop paying them interest to not lend, the banks will be incentivized at the margin to lend more, as opposed to getting money for nothing.
Great, thank you. So I was talking to a former classmate the other day, another former student of yours. He's in the development business and he's trying to buy out a job. And he said, Bruce, do you have any pull? Can you help reopen the Strait of Hormuz? And I said, if
Hmm.
I could, naturally, I would do everything that I could. This is, I think, probably the single biggest factor that's looming over everybody's heads right now. What else do you think is going to happen here?
Well, I'm not a military maven, and I'm not a geopolitical negotiating maven. I don't know that I have any more unique insight. We do know it'll end. Um, how? Do you really think that Saudi Arabia, Kuwait, Qatar, Oman, etc., will forever allow Iran to not allow them access to their own oil and gas? And my answer would be no, right? And I don't know how long they stay patient, but at some point, I don't even know how it would get resolved. I just can't imagine Saudi Arabia saying, yep, and the Emirates saying, yep, I guess all that oil and gas we have is now worthless for the rest of history. And our people will revolt and will be impoverished and killed in the revolution by our own people, um, because we don't want to act against Iran. Do you really think that would happen? And that's the ultimate, if you think about it, if the strait doesn't open. I don't know how it resolves, but I know it resolves. I know it resolves sooner than later. Um, if I had to bet, it'll be some type of tolling system where to get your oil out of the Gulf, out of the Gulf through the Strait, you have to pay $1 a barrel, a half a dollar a barrel, $2 a barrel. Okay, great. So that would eat into them, but it wouldn't crush those economies. Those economies, forget the US, forget Israel for the moment, right? Forget what the US and Israel are going to do. Do you really believe all those other Gulf countries are going to allow Iran to shut them down economically, to literally shut down their economies? And I don't believe that.
Right.
So the solution, and I don't think, and people don't point that out. People talk about Israel and they talk about the US, and I'm not saying Israel and US aren't important, but I think actually more important is we're not going to let you shut down our economy. Our people live too well. We depend on our people doing well to stay in power. And that's what will actually drive the solution ultimately more than anything else. And then, by the way, once it opens up, yes, it'll take a little time to adjust, but what goes up comes down, and that unravels into a deflationary pressure. And actually, the US will lose slightly, even though the consumers will gain.
Thank you. One of the popular topics that you speak on sometimes during these webinars is where should one put their get rich money now, and where should one put their stay rich money now? Can we get an update on that?
I still think, go back to the chart we were just doing, right, as we were wrapping up. Um, I construction costs are going to go up over time in real terms. Real estate, therefore, is going to see values get pushed up, not smoothly, but over time. Over time, multifamily has the least volatile income stream. Um, that's the Sharpe ratio kind of notion. And stay rich, I think it's hard to go against multifamily. That's kind of what that table says. By the way, it doesn't say the others are awful. It just says um, multifamily is stay rich, hold long with relatively modest leverage, and you'll stay rich with multifamily. Um, eh, and by the way, the other categories are not awful. If I said get rich now, I'd still say if you're a developer and you can do forward sales to the hyperscalers or something, probably data centers, but only if you do the hyperscalers. Remember with the hyperscalers, I had a conversation the other day and people were saying, yeah, but these guys have unbelievable cash flows and they have unbelievable, they're all going to win and so forth, right? The four hyperscalers. And you go, well, imagine after World War II, there was huge, huge pent up demand for autos. No autos were purchased in the 1930s, none in the 1940s. And then you have all this income and wealth being created and families and moving to the suburbs and all this. And by the way, you'd be 100% right saying you can't lose over the next 20 years with auto. Okay. And then you'd say, okay, I'm going to build for Rambler a dealership. And I'm going to build another one for Studebaker. And I'm going to build another one for Ford. And you'd say, because Ford and Studebaker and Rambler are great companies, they're not going to go out of business.
Right.
Well, Ford is almost out of Ford, which was the dominant, was almost out of business after the Edsel in 1958. And you then have Studebaker's gone, I think, by about 1960 or so. Rambler's gone by about 1970. And you go, huh. they all didn't win. Even though auto won, right? Auto won huge. Not all auto companies won. So imagine this competition where, I don't know, pick one, pick two, they win, and the others lose
Right.
after playing huge sums. So I think it's a hard game. I think it's a hard game, but you could get rich there.
Great. Thank you very much. Unfortunately, we're not going to be able to address all the questions that have come in, but I want to make sure everyone knows that this presentation is just a digest of what is presented in greater detail in the Linneman letter, which is the quarterly publication from Linneman Associates. More information on that can be found on linnemanassociates.com. As a reminder, if you are registered, you will automatically receive an email link to the recording in about an hour. Thank you, Peter, as always. Thank you, everyone, for joining, and we wish everyone a safe summer.
Have a great one. Bye bye.
Bye.
All right.